All right. Well, it looks like all of us are here. So maybe we'll just kind of jump into it and let the room fill up a little bit. First of all, I'm Jen. Thank you guys so much for joining me tonight. Huff and Digital Dealer. I'm super excited to hear about Refi. Hi, Mark. um, as we were kind of organizing this, I had some people in a couple of different groups that I was in actually bring you guys up in conversation. And so it was perfect timing. I would love to hear a little bit about refi. I see that it's DeFi reimagined. What exactly does that mean? Like, what is farming as a service? I want to just kind of jump into it.
So is that kind of how you want to approach it? You just want to kind of bite
Well,
it right off?
I want to know a little bit about what it is and then how you guys kind of got into it. I mean,
Yeah. So, okay. Yeah, we can jump right into it. So DeFi, 3.0 is, the
mhm.
service-based platform of the DeFi ecosystem. So also known as farming as a service. How we kind of got into this is, we've seen a gap in the industry where, getting involved in farming and, complex DeFi applications is really difficult, not only from a barrier to entry perspective, but from a management perspective as well. And also, if you remember, DeFi summer and people jumping from protocol to protocol, you know, it's not only a lot to manage. Every protocol could potentially be different from the next, right? So there's a lot of research and a lot of understanding that goes into that. And if you don't have the time, to manage all of your farming strategies or manage, all systems and protocols that you're investing with or, allocating capital to, you could be in the negative, right? Like there's a lot of value in farming, but you have to know what you're doing and you have to understand um, how the space is evolving. So refi came in to kind of bridge the gap to democratize, access to farming gains through, a shared treasury or shared ecosystem between all the holders. So essentially, just at a high level, we can go into deeper into this in the call, and if people have questions, I'm open to diving in deeper. But from a high level, when you buy into refi, a percentage of your buy goes into the treasury, and the treasury is used to allocate to different farming strategies across the crypto ecosystem on multiple chains, right? So you can buy on ETH, and refi will farm on all the different chains, AVAX, Phantom, uh, BSC, and we find the new most innovative protocols, and we allocate capital to those, as well as try tested and true things as well. A big we're at the moment, I'd say overall, we're more of the steady growth type of platform rather than more risk on. We're a lot more risk off in terms of um, our approach right now. I'll let Huff talk a little bit more about that later. But yeah, from a high level, a portion goes to the treasury. Our investment teams are using that to allocate the capital to different protocols across the crypto ecosystems, and returning the gains via distributions to the network through smart contracts.
Can I stop you for a quick second? So I remember you mentioned DeFi Summer, right? And I remember first hearing about farming, and I had absolutely no idea what it was. And I don't know why I was immediately intimidated by just the word itself. Like, everybody was posting, like tweeting about all of their farming strategies, and I was immediately lost.
Mm-hmm.
And I was using all sorts of I guess I was researching them at the time and trying to figure out how I really wanted to approach DeFi personally. So I can see, where you guys were going. Did you how did you get into this as refi? Were you farming? Like, what is your background? Now I kind of want to backtrack a little bit.
So my background, I've been in the blockchain space since 2013. I still work in IRL institutional crypto. Um, I'm sure if I I doxed, you guys know who I am. Maybe. I've worked on some of the biggest crypto projects in the world currently, and still working on some of the biggest upcoming as well in my IRL job. So I've been in crypto for a long time. I'm an engineer by trade. I've made my way, more to the business strategy portion or tech strategy portion of the business over time, just because of how my, I guess, not just my personality, but my strengths align. Um, with that portion of the business. And I've been, investing in DeFi since, everything first came out. The days of Aave and, DeFi 1.0.
Huff, what about you? I mean, you're the lead farmer. Maybe you can give us a little bit about your background.
Sure. So I have a traditional finance background. So I was working as a equity derivatives trader for a major Wall Street bank from 2009 up to the period of around 2019. And in that time, obviously just very much engaged in the world of derivatives and risk management. I then left that completely unrelated to DeFi. I left that for my own reasons, just to take some time off. And in that time off, it just married very nicely with when everything was happening with regards to year-end finance, synthetics, and Aave, compound, etc. So what a lot of people refer to as DeFi summer, this innovation coming where you would have borrowing and lending platforms and governance tokens provided to liquidity providers. And that was interesting. And I was doing that more out of just interest and experimentation, and did well on a personal level out of that. And then I followed the developments in DeFi very closely, to the extent that all my passive income was being made from DeFi, and I was just doing things which I enjoyed doing at the time. And so when the concept, and Refi by no means is the first farming as a service provider, although we are one of the biggest, if not the biggest pure play farming as a service provider, I immediately became intrigued, because even though I was farming myself, and I had been doing this for the past 2-3 years, I really understood the product market fit for something like this. And so for me, it was really interesting to tie up the fact that this is something I had been doing for the past few years anyway, with the fact that there's a huge market for people that own crypto assets that want to earn yield on it. But like you said, it can be a very intimidating minefield of acronyms and jargon and all these kind of things. And so immediately I was interested in joining, and I was interested in joining Refi in a way that would make the whole space educational at the same time.
So Refi had already established itself when you had joined as the lead farmer.
No, I'd say the sector had I mean, everything here is relatively new, right? We're talking about an entire sector which is just over 60 days old. So the sector had existed for a couple of days at that point. And I joined Refi on day one.
And when did Refi actually, when did your token sale begin? I want to talk about your token a little bit, because ultimately that's how you participate in Refi, right? You buy X amount of Refi token, and maybe you could tell me a little bit about that. How does that work?
Did you want to touch, or do you want me to jump on this, Huff?
Go for it.
Yeah. So the token sale, just so you know, was a fair launch. There was no pre-sale, and there wasn't any, initially allocated team tokens. So everything was done on fair launch. Team bought them. Most of the team bought on at launch. There was some tokens that were bought back that were, distributed for, incentives to contractors. But other than that, it was complete fair launch on the token. So no pre-sales and no team tokens allocated from the initial fund. In terms of how it kind of operates, so if you buy the Refi token, you own essentially a percentage of the network, right? So you own a percentage of the treasury, and you own a percentage of the yields. So let's say you buy 1% of the Refi supply. So you currently own 1% of the Refi supply. With that, our tax structure changes over time depending on market conditions. So there's 3 portions to our tax structure. There's reflections, treasury, and liquidity. Liquidity is off at this point because we like where our liquidity is in terms of a ratio. So if you own 1% of the network, and somebody buys in the network, that portion of the tax that's allocated to reflections, you are entitled to 1% of that immediately. So that gets paid and distributed to you in ETH. And the ETH is claimable on the Refi DApp on the website. So you just connect your wallet and you can claim your ETH. You're also, you technically own 1% of whatever the treasury owns, which would be the LP tokens, as well as all the treasury assets, which are farming deployed, right? So as that grows, that's an asset that belongs to the network in the proportion of tokens owned. So now when we do a distribution, and the distributions right now are gauged between our management team at Huff's one of the key, I guess, stakeholders making that decision with his farming team, because obviously when you're trying to grow a farm and you're trying to grow the funds, you have to understand how much you're shaving from it, because that's a big portion of compounding into the growth of it. So when these distributions happen, if you own 1% of the network, let's say we distribute 100 ETH, then you would get 1 ETH if you own 1% of the network, because you have 1% of the tokens in circulation.
So how often are the distributions? Like I was kind of reading up on you guys a little bit, and that was kind of one of the questions that I was thinking. How often is it like a specific amount of time, or is it, like you said, when it reaches a certain point and they decide that that's when it's
So obviously, farming as a service is pretty new, right? And the models are changing over time, and there's a lot of iterations till we figure out, the perfect model. The initial model we had, initially we had to build trust in the community. So we did some pretty, heavy distributions in terms of percentage of the farm early to gain community trust, because that's a big portion. Community is obviously everything to us. So the percentages were big then. We switched into, milestone distributions. So when the farm got to, X amount of ETH, 100 ETH, 250 ETH, 500 ETH, we would do distributions based off milestones. Right now we're on a treasury growth sprint. So all the taxes are diverted to the treasury, because we know the faster we grow the treasury, the more revenue it's going to bring to the entire network and its holders. And we did, an on-chain vote to decide where we should put the taxes, and we got about a 60% vote in favor of diverting all taxes to treasury. So that's where we are currently. And right now, what it is a percentage of farm growth every 2 weeks, is what we're doing for distributions. So the model's changing over time, and it might still change in the future. It's a constantly evolving model that we want to make sure that, fits the narrative correctly. And, obviously fast is such a new space, and we're all learning and growing, and, we're trying to build these protocols that, they have been proven and they are working. That's for sure. But what's the most optimal configuration is what we're trying to figure out right now.
I love that, because it's kind of the space in general, right? Like it's not just farming as a service. I mean, everything is pretty new and evolving. And so to be able to evolve with it and kind of change your model along with it is great. So you mentioned that you're on Ethereum and Binance Smart Chain currently, right?
Yeah, that's correct.
So how did you guys, Bancor is looking to deploy on different chains once Bancor 3 is released, and then they'll, proposals and votes. And how did you guys choose where you were going to deploy after Ethereum?
So, Ethereum is initially it was, a no-brainer for us. Obviously, some people, aren't happy about the gas fees, but the security on the Ethereum network, and, the developed resources that have already been created is, above and beyond any other chain, right? Like Ethereum's tried, test, and true, and most of the capital, is on Ethereum as well. So that's obviously a consideration. When we decided on Binance Smart Chain, we looked at capital as a consideration, and users, right? So which one is going to have the most users, which means people are already, we assume the most people are educated on using that platform or bridging to that platform, so it has the lowest barrier to entry, and also gas fees. So the reason for moving over to Binance Smart Chain was because there is a gas fee to claim, even though our head dev, Matt, he did a great job, coding it as just a transfer fee. So claiming the ETH is pretty cheap. It's very cheap, like, you know, $10 to $15 typically, depending on you know, what gas is sitting at. But it's more expensive. So there's an option there to compound the refi, right? And we had this option to compound the refi. I'm just going to touch on this quickly. It's because you have the option to compound your refi, which creates this price floor support on dips, right? Because everybody has all this ETH sitting in their their distribution accounts that, you know, if they haven't claimed, when there's a dip in refi, you see a lot of the network using that ETH to buy more refi, which is supporting, you know, those price fluctuations and kind of keeping it on an upward trajectory and helping the volatility, almost like, you know, smoothing out a signal because the network's involved in it. But to do that, it goes through a Uniswap transaction, and we all know Uniswap transactions are typically really expensive depending on, you know, time of day. So what we did was we moved over the Binance Smart Chain. So not only, you know, can you claim cheaper, you know, the BNB because it's BNB on Binance, you can also, you know, compound into refi at a lot lower of a rate, right? So you don't have that huge Uniswap gas fee. Also, there was something coded into the initial contract on Ethereum where the minimum refi you had to hold to get reflections was 10,000, and, you know, refis had a pretty big retracement over the last bit, but when we were up at, you know, 120 million market cap, getting 10,000 refi was starting to get to a point where it was pretty expensive. So we took that part of the code out on Binance Smart Chain. So now people can hold one refi and, you know, get distributions on the Binance Smart Chain. And so to answer your question, that's a long answer, but to answer it, it was mostly like access and user base. So it had the biggest user base other than Ethereum that we've seen, and had the easiest access and lowest barrier to entry for people to, you know, bridge over.
Well, and the lower gas fees, I mean, they're ideal for DeFi. Sorry, Mark, I think you might have been jumping in there.
So I was just wondering if, you know, since you decided to apply to deploy on BSC, has your attitude towards BSC changed at all, or like I don't mean like, you know, have you turned against BSC or anything, but I mean with the rest of the multi-chain ecosystem sort of emerging, are there other chains that you've kind of got your eye on? Are you applying the same criteria as you applied to BSC, or have things kind of matured a little bit?
So from a personal standpoint, I'm an ETH maxi. So I love Ethereum. When it comes to Binance Smart Chains, you know, the 20 or 21 centralized nodes just doesn't make me feel warm and fuzzy inside. But, you know, when you look at these other chains, I think some have benefits and some don't. What we were trying to achieve, we could have achieved across, you know, any of these other chains, these low gas fee chains, right? We could have done it on Phantom, we could have done it on AVAX, but they didn't have the user base and the low barrier to entry. We're not planning on moving to any other chains right now because there's a huge upfront investment. It costs us about, you know, $500,000 in liquidity, if not more, to bridge over to Binance. And to do that on another chain, we have to do that. And there's very little benefit, right? Your benefit is basically, you know, targeting users that want to use that chain, right? We don't see any technological benefits from it. So we currently don't have any other chains, but that's the logic behind it. And has my attitude towards BSC changed? I think it serves the purpose that it serves, right? Like it's good for a smaller retail base, you know, that can't afford the gas fees and want to get exposure to projects. And with the, you know, the ethos behind refi being, you know, we're trying to democratize, you know, access to farming and, you know, DeFi protocols that even on Ethereum are expensive. It kind of aligned with our ethos, and if we didn't do it, it kind of, you know, I feel like it wouldn't have served the community well, even though it was a big risk, and, you know, it was a significant amount of capital.
Out of curiosity, are the treasuries separate for ETH and BSC, or is it all one treasury for refi period?
So I think I can let Huff touch better on this, but I believe it's aggregated into one treasury and then deployed into, you know, whatever farming protocol we're going to use. So if that's on Phantom or that's on AVAX or that. I believe it's all aggregated and then moved around.
Yeah, so if you think about the BSC launch, obviously any money that goes into the treasury there is in native tokens, so in BNB, let's say. But it does come into an aggregated treasury. And then with regards to myself and the farming side of things, we just manage one pool of capital. And if there's ever a distribution, then we just prorata the amount back either to ETH holders or to BNB holders. BSC holders, rather.
And you guys, I mean, wherever you are in your farming, anybody can go on to, what is it, like a dashboard or something of the sort, and see what sort of progress it is, or what projects you're using, or protocols like DeFi protocols you're using to farm.
That's correct. So part of the ethos which Digi was saying there, when we launched Refi, was to be incredibly transparent about what we're doing, because we felt that there was a huge competitive advantage compared to everybody else that was out there in being transparent about what we're doing and really showcasing where the opportunities lie and how we're looking to take them. And so to that extent, a couple of things. Number one, we tend to tweet in real time every position that we're putting on, at least on a daily basis, if not an intraday basis. And then the second thing is everything is visible on chain. So if you go on DBank or if you go on Zapper.fi, you'll be able to see all our holdings across all our farming strategies, whether it's on Avalanche or Phantom or a different chain, Arbitrum, etc.
What do you think of what are you seeing as the biggest challenge with farming as a service, like in the space right now, with it, especially with it being so new?
Sorry, you cut out. Can you say that again?
Oh, I'm sorry, I cut out. Yeah, I was saying that, with it, especially with it being so new, Huff, I know that you said that you've been doing this for a few years now, but what would you say like the biggest challenges that you're facing?
Refi or farming in general?
I would say both.
Well, farming in general is, extremely complex in understanding and managing, right? Like, I think Huff can tell you, I'm not sure how many lines we have currently, but there's a lot. Like, it's a team managing this, right? Like, not one person can do this because you have so much exposure to different assets. Like, we're lucky to have Huff and his team because they have TradeFi backgrounds. They understand risk management, which is, one of the biggest attributes to refis, that we understand risk management very well. And then, there's the technology barrier to entry, right? Like, do you understand how the protocol works? Do you understand how to operate it? Do you understand bonding mechanisms? Do you understand how to LP? Do you understand impermanent loss? Like, there's a huge barrier to entry to farming that if you don't understand it, then you could potentially put yourself way behind the curve, for lack of a better term.
It's so true. Mark, I had you wanted to add something into that?
Yeah. So one of the things that I was interested about, let's say like very early on in the yield farming crazes, was to see how, so you've already spoken to some of the financial risks, especially with, incentivized liquidity pools, receiving rewards and that sort of thing. But, you guys being on BSC for so long and BSC going through sort of a turbulent time, with regards to the rug pull scams and everything that it was kind of known for a few months in 2021. I was just curious. I imagine that Huff will probably have something to say about it. But how much time do you guys have to dedicate? Like, what's the developer overhead or the manpower that's required to kind of, vet some of these contracts and projects before you end up committing capital to them? Because, a lot of these yield farming projects are like honeypot scams and other things that can be, very easy to get bitten. And I know a lot of clever people that have kind of, ended up by the wayside, even in projects that weren't deliberately nefarious, but kind of just incompetent. And so, I think that in the beginning, yield farming did kind of come with that asterisk that, you do this at your own risk. And some of those risks are obscure. And I just kind of wanted to hear from you guys is like, what's your approach to assessing those risks? Does it influence how much capital you're willing to commit to a certain project? Do you have an internal contract auditing team? It's kind of want to get some visibility on that process. I think it's a super interesting, topic, and something that I think that the community generally would benefit from hearing about.
Awesome. Yeah, I'm happy to field that. So when we think about risk, number one, we bucket every position that we have across a risk type. So it's either low risk, medium risk, or high risk. In the low risk strategies, it's typically stablecoin farming. And there, what we want to do is go to the blue chip platforms. So platforms that have been around for a long time, they've been audited. We can go on things like the bugdoc.io or the defisafety.com reviews and read those up. But ultimately, we're talking about names like Yearn Finance or Beefy or 100 Finance, etc. And for protocols like that, which have been around for a long time, they've got a very well-recognized development team. That's where the bulk of our stablecoin capital will be at any given time. Because you're absolutely right. Risk is super important. And when it pertains to a bulk of the portfolio, which is, let's say, 40 to 50% of the portfolio at any given time in stablecoins, we want to use the blue chip platforms. When we start going up the risk curve, so we start thinking about where do we want to provide liquidity and be a LP provider, or where do we want to take directional long-only bets in the high-risk bucket, that's where we again prefer to have a relationship with the protocol before putting any money down there. So I'll give you a couple of examples for that. Obviously, many people here will be familiar with Curve and Convex and putting money on those two platforms. And we would consider those in that kind of blue chip category. When there's somebody who's operating kind of on the periphery of what they're doing, let's say somebody like Bent Finance, who want to be a derivative of Convex, our preferred thing to do there is, number one, yes, between the three of us on the farming team, we will review the contracts and we will take a look at the safety features and all of those considerations. But number two, we'll actually connect with the protocol themselves and we'll ask a whole bunch of questions. We'll get a sense of the team, what they're building, how long they've been there for. And often that sense check, just from speaking to the teams alone, is really valuable. We have a podcast series, and I think a lot of the value actually for the podcast comes before and after we host many of these DeFi protocols on our podcast, because we really get to question them on their protocol and where they're going with things as well. So for us, a large part of our due diligence is formal, and it's done in the form of reading contract reviews, and we have 3 people on the team, and we've got people that we can lean on the dev side of things that can really understand the code there. But ultimately, our modus operandi is a couple of things. Number one, we want to go to blue chips where possible. Number two, our job in farming isn't really to be mercenary capital and move from platform to platform. It's just to extract yield in a consistent, sustainable manner and then pass that back to our holders. And we mitigate the risk by, like Digi alluded to, by having over 100 lines in the portfolio. So we never have more than a percentage of the portfolio in any single vault or DeFi protocol. And just in terms of the high risk bucket, we have almost never allocated capital to a brand new protocol. So we tend to prefer, if I think about this, the riskiest thing that we might have done is put money in something like Redacted Cartel and the Butterfly token, which, if you know the kind of people that were behind that and the genesis of how that came about, the chance of that being a rug pull was really low.
And yeah, I think that this is, just for people listening, I think that this is one of the unspoken, right, or at least, under-recognized value propositions for something like Refi, is that, if you are a retail farmer, you probably don't have the time or expertise to make these kinds of judgment calls. You know, I think that this culture of kind of aping into every new yield farming position that becomes available has really, you know, hurt a very large number of people. And to sort of ape safely, if I can phrase it that way, by having a protocol that's got devs behind it that are, you know, willing to come on an AMA and speak to the larger community and address, you know, some of those these questions about smart contract security and everything else. It's such a valuable proposition, in my opinion, and I have enormous respect for the project and everything you guys are doing.
Thanks, really appreciate it, Mark. And you've been a great help, you know, kind of early on helping us understand our liquidity pool situations and making sure we didn't run into, you know, some of the typical issues that projects with reflections have seen in the past.
One of the other things that I wanted to ask you about was, you know, because Refi has accumulated already a huge amount of value. Have you guys ever considered sort of approaching something like Nexus Mutual to sort of, you know, help cover some of this smart contract risk, like with their like level 2 coverage policies or something like that, or getting sort of like a generic insurance policy for Refi and everything that it does?
Yeah, so I can touch upon that. So Nexus Protocol and InsureAce are the two that we've looked at. We haven't formalized any contracts there, but as Refi gets bigger, absolutely insurance is going to become a key consideration for us. So right now we run a farming portfolio just shy of $3 million. And to my point about diversification, we'll only ever have a maximum of 12% of the portfolio in any given vault or protocol. So currently the most money that we have is actually on 3 different vaults on Beefy Finance. For us, as we grow, in absolute terms, 12% can be a lot of money. And at that stage, it makes sense to pay the insurance premium to underwrite some of the risks in these smart contracts. So absolutely, we're aware of some of the major providers there, and it's something which is interesting for us.
Yeah, and just to touch on, you know, that point as well, insurance. We do currently use, you know, some protection in terms of multi-sigs and things like that, but we are looking to work with, you know, more of a well-rounded digital custodian to help us out. You know, been looking at things like Fireblocks, which I know extremely well. I've worked with them a ton in the past, and I know they insure digital assets as well when you use them for their digital custodian services. So also things we're looking at as well.
Quick question. So you mentioned 12%. Now that could also change in the future, though, as you are kind of evolving, like we were talking about earlier. Now, or is that kind of something that you guys have just decided on?
So we're in the process of formalizing our investment mandate, but since the genesis of Refi, we've been putting out articles on Medium. One of those articles is titled "How Refi Thinks About Risk," and many of these things that I'm alluding to, the points around diversification, the points around assessing smart contract risk, the points around actually speaking to the DeFi protocols before we put any sizable ticket on there. They're all things that we've written about in December, January, and most of this month as well. So that will just get formalized into an investment policy doc. And once it's kind of put into a mandate, then there'll be even less flexibility for us. So right now we stick to it because that's what we've publicly said we'll do. The moment that becomes kind of crystallized into words and in a policy document, then yes, even more adherence to those rules.
Great. I would, unless you guys have anything to add, I'm kind of curious. I'm thinking I see some familiar, faces. I've joined in on a couple of your spaces calls, and I'd like to open to the community and see if they have any specific questions for you that we might not have answered, or that they have, you know, currently, if you guys don't mind.
Yeah, for sure. That's what an AMA is all about.
Awesome. Okay, so if anybody, any of our listeners do have any questions, please feel free. They have completely expressed transparency, so don't be shy.
Maybe while we're waiting for community members to nominate themselves, I just wanted to ask: have you guys, my community will kill me if I don't ask this, but have you guys considered distributing capital to the Bancor protocol and to for yield earning opportunities there?
We have, and I think there's a couple of interesting things about Bancor, especially with the kind of V3 side of things, which is really, really interesting. But for us, the idea that there's little to no impermanent loss is obviously really exciting, especially given our kind of risk mitigated approach to investing.
Go ahead, Link.
Yeah, so my question really is actually for Mark. We've been talking a lot in regards to some things that are coming out in Bancor version 3. And as I'm listening to this call again, I can't help but think that although Refi is not listed with Bancor, but how the concept of this superfluid liquidity that is somewhat coming down the road kind of plays into maybe what they're doing as a holder that can also then possibly utilize their stake in Refi to then also have availability of the markets. Can you speak to that a little bit?
Do you mind elaborating a little bit, Link? So you mean someone with a stake in Refi or a stake in Bancor?
Well, meaning like we've talked about like in version 3 where protocols that have stakes on Bancor can then be given an equal token back, and that becomes available to possibly used in other places.
Yeah, right.
Yeah.
So the problem that Link Semper is talking about is that I've been looking at the performance of some of these staking tokens over the last 12 months. And I've been trying to determine whether or not the bull thesis that's usually, espoused for these types of tokens is a good one. And for those who aren't familiar, that bull thesis is essentially that as a token becomes performant, that the incentive to buy it and lock it up in some sort of contract, whether that be as collateral, to produce some other type of value, or to secure a network, or sometimes sometimes just to lock it up for its own sake. That drives a scarce economy and drives price appreciation. So that's the bull thesis. I noted at ETH Denver during my workshop that there's a symmetry to that argument that's usually neglected, which is that if there's potential for massive price appreciation due to scarcity, then it's equally true that there's potential for massive price depreciation. Because the slippage or basically the poor capacity to absorb large trades or speculation on an asset. It means that the upside and the downside potential is approximately equal. But for reasons I don't yet understand, it looks like that the downside potential is heavily biased. And so there are a handful of projects that I could talk about, but I don't want to risk putting any of these projects on the spot, particularly because some of these projects are phenomenally good. It's just that the illiquidity of their token has unnecessarily and unfairly hurt them in the long run. And so for Bancor version 3, we've tried to introduce a new sort of liquid staking primitive where the single-sided pool token, because it is denominated entirely in the token that was provided and is insured 100% from impermanent loss, that it has the same sort of financial utility as the token itself. So, for example, imagine a hypothetical protocol where you stake token in order to secure a network or something. And to disincentivize bad behavior, that protocol will threaten to slash those tokens that you've provided. this is perfectly healthy and it's a very sound design. But as that network becomes extremely popular, it means that the large number of tokens that are taken off of secondary markets and then moved into that network means that there's this threat of illiquidity. And in particular, that means that the market can lose confidence in the price of the token that they're being quoted. And so that's something that Refi is already perfectly aware of. As they mentioned earlier on in this call, they do pay attention to their liquidity ratio, which is something that I wish more projects would do. And yeah, many don't. And so this kind of competition between liquidity and staking has, it is a recognizable problem. And so the Bancor pool tokens have been designed in such a way that you can supplant the token that it is that it needs for for the Bancor network pool token that it represents. And so, yeah, I do think that there is, there could be some synergy here. I need to, I don't want to put words in Refi's mouth, obviously. And so, I do think that we should have a longer conversation about it. But I do think that, this approach, it might not catch on straight away. I already know that there are a handful of projects that I've spoken to behind the scenes that are very, very interested in adopting this solution for their own contracts. And I suspect that will have follow-on effects after people see what the advantages are of maintaining healthy liquid markets for their token. So if there is any potential for collaboration, it doesn't matter that Bancor hasn't whitelisted Refi, right? The reason we can't whitelist Refi is because of its reflection mechanics. And even then, I still think that there's still a way that we can offer whitelisting on Refi at a later date. We just need to work out between our two projects exactly how that should occur. But yeah, I think whether or not it's with the single-sided pool tokens or any of the other features that Bancor has yet to announce, I do suspect that there's going to be a lot of room to collaborate, and I'm really looking forward to that.
Yeah, we're completely open to to that as well. And I think our reflection mechanism is a little bit different than typical reflection mechanisms, as it's not in the native token, so I guess it blunts a lot of the challenges that you see in typical reflection tokens.
Yeah, that's right. It's an atypical reflection token, which makes it much more attractive. But whitelisting the asset itself it kind of defeats the purpose because it's a special setup that you guys have. But that doesn't mean that we can't collaborate in other ways.
I agree. And liquidity ratios is something we do pay attention to. There was a lot of thought that went into the BSC liquidity ratio, and off a protocol that treasury growth and network distributions really operates off volatility. I know people want to see sometimes the most liquid assets, but having a lower ETH to Refi will create a lot more volatility, which would in turn create more value for the network. So we ran a few different scenarios on even where market cap's going to start if we do this and that, and how those scenarios would play out with different liquidity ratios, and obviously we don't want Refi to get too liquid because then the volatility kind of hold the growth.
Yeah, absolutely. Yeah, and for anyone that's listening, it's not my position that any project should aim to be as liquid as possible. There's what Digital Dealers has just referred to here is that you do need to have something that is sufficiently liquid that the market trusts the price that is being quoted. But you also want something that is a little bit illiquid so that there's still room for price discovery, right? If something's too abundant, then it's difficult to know how the market is going to make up its mind as to what that asset is worth. And so there is a balance here, and finding that clutch point between stressing the markets too much and giving them too much slack is it's more of an art than a science at this stage. But I do applaud Refi for thinking about it, because I really do think that this is something that is usually a ham-fisted afterthought at best, and it's just nice to see it done so well.
Yeah, it's very important. We definitely still want to incentivize, arbitrageurs to come in and, having, we have two different ratios of liquidity between, or yeah, we have two different liquidities on, we have a more volatile asset on BSC and we have a less volatile asset on ETH, and which still has volatility on ETH, but that was by design because we want to incentivize arbitrageurs to, bridge between the networks to kind of help create that volatility. But at the same time, we still want people to be able to swing trade refi as well, because there is, a tax on it in and out. So the volatility that you need to make a swing trade profitable changes when you have that, right? So we had to take that into account. And I know a lot of the community was asking us, when is BSC launching? When is BSC launching? Or when are you bridging to another chain for the retails? There was a lot of thought, a lot of design that went into it. And that's why it took us kind of, a little bit longer than we had planned, because you only get one shot at it, right?
Yeah, exactly. And, I think that, I empathize. Our community has been harassing us to launch multi-chain for forever. And we've got all of the same challenges with regards to, liquidity and what we can afford to insure and what's reasonable. But then on top of that, what is governance going to look like? And, there's been a lot of pressure for cross-chain utility, whether or not that involves something like CCIP or something else. So yeah, it's for everyone listening. You got to give your devs a break every once in a while. This multi-chain stuff is a huge headache.
Yeah, I was just gonna say that, especially too when you think about, like, if you have a project that you're developing and you don't think about, the architecture multi-chain initially, which a lot of people don't, right? They think about like the architecture of the project to work in, a blockchain atmosphere. But if you don't think of a situation where, like, think of like reflections, right? If you have a reflection token on three different platforms, if you don't think about the architecture and how to combine those reflections and bridge them between smart contracts to, aggregate volume, which, by the way, is a very difficult problem to solve and no easy undertaking to do, then when you get to that point, you're not really set up to do that, right? And if your protocol wasn't initially designed to be multi-chain, then you got to kind of get creative, and that's where the fun comes in sometimes.
Yeah, I mean, necessity is the mother of invention, right? If you got a problem and no one solved it before, then that's when you know that you're onto something special.
Completely agree. I love that quote.
I have a quick question. How long ago did you guys deploy onto BSC?
I don't know the exact date. I believe it was Super Bowl Sunday. How do I miss that? It was Super Bowl Sunday.
Okay, so super recently then. And you still found it advantageous over, Phantom and Avalanche. You farm over there, but launching, you still found it to be an advantage.
Yeah, if you look at the capital on BSC, it's not even close, right? There's a lot more money flowing around on BSC than there is on Phantom. If you look at like the market cap of the native token, it's easy to decipher. And BSC has a lot of users. Obviously, it's linked through Binance, so the barrier to entry for people to get on it is pretty low when you have Binance educating people on how to use it and having all the documentation on their website on how to get onto it. When you look at something like Phantom, even though Phantom is a great network, they're not Binance, right? So they don't have the user base to kind of aggregate over to Phantom, and the barrier to entry is a little bit higher. There's not as many users, there's not as much capital, and those were the deciding factors.
I just want to state quickly for everyone on the call, because I think that often some of the comments that get thrown around on these AMAs can sometimes be taken the wrong way. I promise you that no one on this call is bearish on Phantom or BSC or anything else. These conversations are completely sort of matter of fact. We're espousing these things completely unemotionally. And I personally, I'm quite enthusiastic about Phantom. as well as, even some of the blockchains that have zero DeFi or, near no users right now. It's just, we always have to make decisions as developers within the time that we are, expected to see results. And we can't always afford to be, starry-eyed about the future of stuff. We just have to make decisions with the data that we currently have. And with all of that said, BSC was absolutely the right decision. And early on with Bancor version 2.1, our community and the developer team was extremely enthusiastic about BSC as well. So it's a fair point, and I don't want anyone to take offense, right? It doesn't mean that we think Phantom is bad. It just means that it's not as it doesn't have as much capital as BSC. That's all that it means.
Yeah, and we're extremely bullish on Phantom as a network. I like seeing all these like blockchains succeed and the variability between them. I don't think it's an or, I think it's an and in terms of these blockchains. I think, each one, there's room for many for different reasons in the ecosystem. But a lot of our capital initially was deployed to Phantom. I know Huff has been extremely bullish on Phantom, but we made a business decision, right? It was a business decision for Refi, and that business decision at this point in time, the right decision was BSC for us. That could change over time, but that's what we decided to do, and we think we made the right decision, but only time will tell.
I hope that I didn't seem like I was, questioning that. I think it's more, you guys are the developers. And I guess as a member of the community, I'm just curious how you come about making these decisions, like what goes on through your head when you're deciding on where to go. So now I had another question. You mentioned that somebody can get involved with one refi over on BSC. Is it still 10,000 currently on ETH?
Yeah, it's still 10,000 on ETH. We're working on some potential staking mechanisms to lower that, but it's just like right now we have the lowest, I guess, barrier to entry was us launching on BSC because it took care of so many things that the retail investors wanted. Not only was it lowering that 10,000, it was also lowering the gas fee and a few other things. So that's why we decided to do BSC before staking. But we are looking at some unique staking mechanisms, and we have some things in the talk that I can't talk about yet. But we're always testing and iterating and trying to find new ways to incentivize the network and grow Refi, right? So that's our job, and we're constantly, obviously, we're in the blockchain space. You got a bunch of innovators in this room. Everybody, every PFP I see is an innovator.
Hey, dude, I got
Go ahead, Link.
I was going to say a couple questions for you. You guys have been, given farming as a service is really still a very young sector of crypto right now. But at the end of the day, crypto moves fast. You guys have been around long enough and dealt enough. Two kind of questions I'm curious that I think would be good quick statements to make or impressions to give to anybody that might be listening, especially if they're new and they've never heard of farming as a service before. What do you guys see as kind of the biggest hurdle that you've seen as a farming as a service project, as developing the project itself? And then what things as an overall exciting part of the sector? For me, I think about there's lots of different farming as a service protocols out there. Many are good, some are not so good. But they all have different strategies, of course, and that makes them kind of very unique, each one in itself. And I'm curious to get your guys' take on what you see as farming as a service as a whole, and specifically with your project, kind of what have you seen as the biggest hurdles that are in the space as a whole?
I think the biggest hurdle, and Huff can answer this as well, is, projects take time, right? A lot of the crypto community is great, but crypto's always been, a very, for lack of a better term, fast-paced space where it's one project to the next. So if you're not innovating and you're not fast and have quick returns, you could run into some challenges, and that's not Refi's model. Refi's, we're very we assess risk deeply, and we try to mitigate that risk as much as we can. So, we're looking at more of a sustainable model. So we're looking long term, and price action changes. We don't pay too much attention to price action because that's not what we're here for. We're not here to look for exit liquidity or pump up a token. We're here to build a project that is a sustainable network long term for retail and institutional community. So that's what I see as one of the challenges that I've ran into, as well as marketing. Educating people on it is I think we're doing a very good job of it, but it's so new. I think the marketing piece on how to get in front of the right people and educate them on it, because not only is crypto new and farming new, this is new to the new to the new, right? So you got to educate on all the priors. Like yesterday, we were on a call. I believe it was yesterday. We were on a call with Rare Breed Ventures. So they're a $100 million VC firm out of, I believe, San Francisco. And we had a discussion on with their following. And we really had to educate them from square one, on what farming is, and how to relate that to traditional finance, and how does that relate to traditional finance? Kind of like a market maker, you're providing liquidity, so you have to bridge all those gaps. So the challenges that I see are the sustainable growth isn't with a lot of the typical crypto ethos, and which I think will change over time, and I think that's a huge value add for Refi, to be that part of the ecosystem. And also, the marketing and the education is somewhat challenging, but fun at the same time.
If I can just piggyback off that, I'd agree there with Digi about the biggest challenge is there are investors in this space who are quite myopic and short term in their thinking, and that reflects as their patience. So as many people will know, and I'm sure Bancor and its following will know, it takes time to extract the yield from different farming opportunities. And yes, you can make some good returns in the first kind of 24, 48 hours of relatively new protocol. But when it comes to auto compounding a position or crystallizing the APY gains on a stablecoin farm, those things take time. And we are still relatively new, this idea that we're 2.5 months old. And what we're finding is pockets of the investor base who are expecting those returns almost immediately. Now, that's not to say that we haven't been distributing back. So Refi has paid a total of north of $4.5 million back to its holders since inception. And yet, despite that, you still see some people saying, I want more, and not necessarily realizing that as it pertains to yield farming, especially as DeFi matures, it does take time to extract those opportunities. And we're seeing pockets of the investor base that are a little bit impatient, and that's just a nature of crypto as a whole, that it moves quite fast paced, and people are used to these exponential gains in a relatively short period of time. With regards to FAS as a whole sector, we're big believers that the success of even our competitors is good for us. It brings more capital into the space. It raises awareness of what everybody's doing, and then it's up to people to allocate where they see best for their needs. So I think the Refi proposition is very much one of, we're going to run this as a billion-dollar business in the way that we conduct ourselves. The background of the people on the team is very institutional in nature. And that's very much the mindset with which we're growing the business. So you won't see Refi operating in the world of memes and things like that, because that's not our preferred modus operandi. Our preferred modus operandi is very much about institutional grade reporting. It's about institutional grade governance, and it's ultimately about building something which will be sustainable for years to come, not just riding the wave of FAS, which is new as a concept, and you see many people come and go in that space. Like Link said, our goal is to be transparent, to be professional, and to be sustainable at the same time.
Thanks,
I think
guys.
you kind of answered. Oh, I'm sorry. I had a question that was sent to me, and I think you kind of answered it. It was, for somebody getting into this area here, the farming as a service, what are a couple of specific things that they should be looking out for when comparing, refi with competitors? And I think you kind of answered that a little bit for them, unless you have something that you'd like to add to that question specifically.
Yes, I think the toughest thing in farming as a service is how do you value these protocols? So let's take Refi, for example. If you assume our market cap today is at $25 million, how do you value Refi? Because we have a productive asset, which is the farm, which is $3 million. And to date, we've paid distributions of $4.5 million, right? So if you're doing a classical valuation model, what is the projected future yield from Refi? And what's the present value of all those future cash flows? So if we've paid out, let's say, $5 million in total, and there's an asset there that can grow and pay out the same ratio over the next, let's say, 18 months, how do you value that today? Is 25 million cheap for you, or is it expensive for you? And then you can run the same exercise with your competitors. So you'd compare the market cap to the size of the treasury, but also you have to factor in the fact that dividends have been paid already by Refi, which is something which makes us unique. I think the other things to look out for when somebody is deciding which fast provider that they want to go with is very much what is their attitude towards risk, what is their track record so far. And I think what's encouraging for all fast providers is we have effectively been in a bear market for the past 2 months. So it's been a stress test of those that can actually manage and navigate those waters really well. And that's something that you really need to look at under the hood, is which fast providers have been consistent and navigating the waters well, and where have those returns been coming from? Have they been coming from speculative plays and one-offs, which are tough to replicate over a long period of time unless you are in a bull market? Or have they come because they have a really truly diversified portfolio of farming opportunities that they're constantly extracting?
Huff, do you find it like that much more challenging being in a bear market and farming right now?
I thrive off it. I think it makes our job a bit more difficult for sure, because you've got to be constantly watching the markets and be a lot more active than you do need to be in a bull market. So for example, to this point of active management, we're using all the tools available at our disposal, and we're turning over the portfolio and we're changing positions several times a day. And so that level of vigilance is heightened in a bear market, because you've got to be quick to enter and exit trades. And if you are going to put any hedges on, you've got to put them on and take them off again. So in a bear market, I think you've got to be a bit more vigilant. The market isn't as forgiving in terms of making a bad investment, and you've got to be quick. So my preference would always be to have a neutral market or a upward trending market. I think any liquidity provider would be the same, just because volume flows accordingly. And you do have a directional long only bias when you're providing liquidity on more exotic pairs. But at the same time, I think it's really an interesting time to launch a fast project, because if you can pass that stress test, you've effectively proven the business model can work in any market condition, in at least the toughest market condition, which is a bear market. So for me, it's encouraging in a way as well.
Yeah, and I'll just add to that, kind of on the valuation side and on, differentiators. I'm a big earnings guy, right? So I look at earnings. I know there's a lot of business out there for my investments that, especially even I'm talking traditional, but if you're looking at crypto, there's so many businesses that launch that go, massive market caps. And like BetSwap is one of those $500 million market cap with no working product or coming inflow, when you have things like Mystic Bets that like has a working product and is making money, right? And it's 500 million to 500,000 market cap. So those are the kind of things I look for. I look at earnings. I want to see projects that are making revenue or making tech progress. And if you look at Refi, distributed about $5 million already. There's, $3 million in the treasury, so it's about $8 million in revenue in, let's say 10 weeks, right? Not to mention we have about, 2 to 3 million in LP tokens that are part of the treasury as well. But say about 8 million in 10 weeks. If you do a run rate for a year, right, that's 41 million in revenue, 42 million, maybe more. I'm just doing the calculations in my head of like 800K a week, right? So it's about 42 million a year in revenue. And if you take, typical, industry metrics in financial markets, what's your rate on X times earning, right? Like standard rates for some early tech companies is I think like the benchmark is 20 times earnings, right? So if you go by something like that, market cap or refi should be upwards of 800 900K, or sorry, 800 900 million, closer to $1 billion. But there's risks associated, other things to factor in, and everybody's got to make that decision for themselves. So I would look at earnings and performance for sure in terms of how these treasuries are doing, and are they making money, and also what they're focusing on, right? You'll see a lot of projects come in, and not only in the fast space, but in spaces in general, where they'll have an initial ethos. And I understand good businesses pivot, but it's almost like you see these projects that jump from a hype position to hype position. Like they'll change from like, farming to investments, or like a hedge fund, or maybe like nodes, or like more of an ETF sort of scenario, to try and hype up, almost like a jack of all trades, kind of master of none. Whereas refi, we've been focused on farming, and we haven't strayed from that at all. Our focus is to grow the farm through farming protocols, where we haven't done anything else. We haven't introduced any other types of tech. Every piece of tech we're building out are tools to help us farm better. So we're positioned as, a pure soul farming as a service. When you're looking at, some competitors, they're multifaceted businesses, which might be good for you, right? That's what you might want exposure to. But if you're looking for, very clean and concise, I would say refi. If you're looking for, a little bit more, fancy bells and whistles, then there might be some other protocols out there that work for you.
Awesome. Thank you. I think that answered their question really well. I don't have any other questions. If anybody does, please request it to speak. But before we end the call, you guys had mentioned phase 2. Maybe you could just tell us a little bit more about phase 2, and when that's going to be kind of going into effect.
So we're already in phase 2. So phase 1 of refi was very much about raising awareness and raising capital. And to a large extent, we achieved that. If you think about the numbers which Digi just shared with regards to treasury growth and distributions back to our holders. So we did a snapshot vote, which was an on-chain vote for a change in our taxation structure, because one of the criticisms of FAS in general is that it's dependent on volume to be successful. So if you think about reflections, ultimately how that works is that every time you buy or sell the refi token, there's a tax, and a percentage of that tax goes to existing holders as a volume-based tax, and that money then is paid out. A lot of the criticisms that we received around farming as a service as a sector was that the model isn't sustainable if volume dries up. And this is the feedback we were getting from some of the more institutionally minded investors. So different VCs and different DAOs, as well as big names in the DeFi space who we've had on the podcast. And so to address that and to bring in a wider investor base and to really prove the sustainability of our business, we launched phase 2. So under phase 2, we actually turned all reflections off, and the community voted for that. We're now a couple of weeks into that. We're about 3 weeks into that. And it's been a success because of the following. Volume has dried up over the past few weeks. And that's a function of the markets obviously turning slightly downwards and people being risk off, which includes just going into stable coins themselves. And yet, despite that, the other day, we managed to pay a distribution back to our holders purely based on how the farm was performing. And so for us, it was a huge check mark in terms of proof of concept, because phase 2 is very much about proving the concept of farming as a service, that if you have a productive asset, the farm, which is generating yield, even if there are no new buyers or sellers of the Refi token, we have a business model which is sustainable in the medium to long term. And so we're still relatively early into phase 2, but if I could take some of the kind of metrics to assess whether phase 2 has been successful, we started it when the farm was at 2.6 million. We've subsequently, in that period of time, seeded a liquidity pool and bridged over to Binance Smart Chain. We've paid out some distributions in that time. Our farm has grown over that period of time, despite the market being down anywhere between 20 to 30%. And so on those things alone, we're pretty confident that phase 2 has had the desired impact. Ultimately, we'd like to run these kind of decisions with regards to tax and how the business is structured back to the community. And so phase 2 has certain milestones in mind, where the farm goes from its current state of just shy of 3 million to 4 million and then 5 million. Once that target of 4 million is reached, we'll do another snapshot vote, which we anticipate to be in the coming weeks.
Up to 5 million in the next couple of weeks. Is that what you said?
Up to 4 million, which is the milestone for doing the snapshot vote again on taxation, and then 5 million will be paying our biggest distribution back to holders at that point.
Yeah, and just to think, like, the farm's been growing through quote unquote bloodbath. It's been quite a brutal downturn in over the last few months. And chop is some of the heaviest stuff to trade, right? Like if you're in a pure downtrend, you can have a bias towards risk off and pull everything out, right? But when you're getting these choppy conditions like we've had with some volatility in the same ranges, it's not the greatest trading conditions for trending trades, right? So that we've managed that, and we've seeded the 500,000 plus liquidity pool over the last couple weeks, plus the farm has grown a substantial amount and we've still paid distributions. Really is a testament to the model that we're operating off of, and we've covered all operating expenses in terms of development and community management and things like that as well.
That's awesome. Still successful in the most difficult time, I would say. That is, like a big obstacle. So congratulations on that. What is the best way to ask you guys questions? I know they might not have any now, but I know we had some people requesting that we record the spaces, and after they listen to it, I know you have a Telegram. What's the best way to contact you? Would it be Twitter or Telegram, or how would you advise they contact you?
Me personally, you can send me a DM. I'll probably respond. I don't know. I get a lot of DMs, so either Twitter or Telegram. If you have a question about refi, there's a slew of community members and mods in the TG. You'll ask a question, you'll get like 5 answers, and I'll turn it into a discussion. The community's been amazing. We have one of the greatest communities around, and everybody's extremely excited to have this project succeed and give their input, which has been how I've connected with Mark and Link and the likes of Bancor, is because helping us, giving us advice on things we might not have thought, or getting involved. So we're really big on community. So I would say jump in the Telegram is probably your best bet if you have some questions and engage the community.
Great. Well, unless you guys have anything else to add, I think we'll go ahead and end it. But thank you all, Huff and Digital and Mark, for being my guest tonight. I really appreciate it. And thank you so much for explaining everything about refi and just farming as a service in general.
Yeah, I really appreciate being on. Hopefully we can do this again. Like talking to you guys, and maybe we can have an open spaces talking about some of the synergies between refi and Bancor one day.
Yeah, let's do that.
Awesome. Well, thank you guys. Have a great night. And thank you to all of our listeners. for
Thank you,
joining us
Jen.
tonight. Yeah, no, absolutely. You guys have a great night.
You as well, Jen.
Amazing. Thank you so much, guys.
Thank you
appreciate
so
it.
much.